There's a really interesting question as to what markets are susceptible to technical analysis and which markets aren't. And this is a very interesting question, and I think the way to begin to answer that is to go back to the beginning and think, what is the sort of perfect market for technical analysis? And it might be best described as an intelligent crowd, or rather what other people have called a wise crowd. A wise crowd in the sense that they don't all act together, they don't imitate each other, they don't act as a herd, they're not irrational, nor over-emotional, nor panic-stricken, nor greedy altogether, but they're independently thinking crowd of participants. I don't mean literally, I mean just all the people that feed into a market are independently thinking. So the sort of obvious crowds there are foreign exchange crowds, which draw from every type of participator, whether it be end users for trade, hedge fund speculators, short-term day traders, long-term speculators. At the other end of the spectrum of crowds, or not crowd-like behavior, it might be, for example, the egg futures market in Chicago, when there's perhaps 2 or 3 players. Very illiquid market, just 2 or 3 people participating in the price fixing of eggs. More usually, you could consider crowds like stock markets don't always behave like crowds. They very often have a wide range of participants, but at certain moments over time they can suddenly cease to behave like an intelligent, independently thinking crowd and become a panic-struck crowd. Their stock markets are very prone to panic flights. When there is neither a crowd, or the crowd isn't behaving intelligently and wisely in a market, technical analysis is at risk. And traders need to understand when technical analysis is, shall we say, vulnerable, when the market's changed or when it didn't have a crowd in the first place. And at those moments you must step back. And typically the way to get a handle on a market that hasn't got a crowd or is behaving irrationally, unlike a wise crowd, is to step further and further back, take a longer and longer time frame look at the market. The consequence of taking a longer time frame of looking at a market, from weekly to monthly, from monthly to quarterly, and even from quarterly to yearly, the consequence of that is, of course, your trading decisions are based on signals that take a long time to come to completion, take a long time to be confirmed, and take a long time for their targets to be reached. So it has huge implications. If you drop back from a 5-minute chart to a 1-yearly bar chart, the implications for your trading are equally dramatic, which is more or less the same as saying you're withdrawing from the market.